Hello everyone, and welcome to another ASUG Partner webcast. My name is Susan Rebolletto, Membership Support Specialist here at ASUG, and I'll be your moderator today for this event. I'd like to thank everyone for taking the time to join us today for this presentation. Today's webcast is being recorded. The link to the recording and the accompanying slides will be posted to the ASUG website, and all registrants will receive an email with the link to those materials. I'd like to remind our audience members that you can submit your questions at any time by clicking on the purple Q&A button at the bottom of your screen. Today's webcast is titled Ask a Fixer, Analytics-Based Enterprise Performance Management, and is brought to you by ERPfixers, an ASUG partner. Before we get started, I'd like to give everyone some brief background information on ERPfixers. ERPfixers is an online platform that quickly connects you to SAP consultants and system experts so you can obtain quality, immediate solutions for your most pressing SAP issues. Thousands of experts from all around the world are part of this vast online community who are available to help and assist you with their knowledge in SAP. Our speaker today is Gary Kokens. He will be taking over the presentation. And again, if you guys have any questions, please feel free to submit them using the purple Q&A button. Gary, I'll hand it over to you.
Well, thanks, Susan, and it's a pleasure to be presenting to ASUG. I'll describe myself in just a second. Actually, I might as well do it now. My career has been in what I would call three-thirds. My first decade was in industry with FMC Corporation as a division controller, then became an operations manager. Middle 15 years in consulting with Deloitte, KPMG, and then Electronic Data Systems, EDS, which is now part of HP. And up till 4 years ago, when I retired from SAS, I was with SAS for 16 years. So that adds up a lot of numbers. So you can probably guess my age. I'm 68. My grandsons are 15 and 18. I was raised in Chicago. And a little bit about my schooling. My degree from Cornell was in industrial engineering and operations research. I did my MBA at Northwestern University's Kellogg. I like to say that I'm an engineer masquerading as an accountant because most of my career has been in the CFO space. I need to manage your expectations. This presentation is like an MBA curriculum in 60 minutes. I'm going to go very fast, so there is some time for question and answers. But if not, I think my email will be on the last slide, or you can go to my website, which is at the bottom, GaryKokens.com, and send me a message there. I'm partly retired, but I still do have a little bit of fun. I especially enjoy education. So let's go. Who will benefit from this presentation? Managers who have previously struggled at promoting financial planning and analysis, enterprise performance management, and integrating business analytics into their decision support systems. Managers who intend to champion any or all enterprise performance management and business analytics improvement techniques, and they need a compelling call to action. And the reason I have champion in quotation marks is because although my observation is that it's nice to have senior executives provide sponsorship for new initiatives, often they are preoccupied with firefighting or short-term priorities, and it's typically managers 1, 2, 3 levels down from the C-suite who kind of have passion, fire in the belly, and kind of ask, how long do we want to perpetuate some of these stale or archaic methods? And they're the ones that will do a proof of concept or a pilot or a rapid prototyping event to demonstrate to their colleagues and maybe their executive managers that this is the way to go. So I really enjoy presenting to middle managers. I've been fortunate with SAP. I have presented at 8 of their conferences, including in London, several of them as a keynote speaker. I think SAP is the horse to ride. I don't want to take shots at the other vendors, but it just makes a lot of sense what they're doing. So I like to start all my presentations with these 3 questions. What, so what, then what? So imagine that you implement one of the methodologies what we will be describing here as part of EPM, so like activity-based costing for customer profitability. I say celebrate for 1 day. You are not done. You're going to have a lot more information that you've never seen before. And so what is relevant in it? And that's the so what question. But arguably the most important question is the third one, then what? Which is the predictive view. What are the consequences of some of our decisions? If we drop a product line or add a new customer segment, what will be the financial impact? And we will talk about that predictive view. So my agenda is I'm first going to try to clarify the confusion and lack of consensus about what is this enterprise or corporate performance management. They're synonymous. Briefly talk about business analytics. Then discuss what I call the 8 pressures that have caused interest in enterprise performance management. I'll give you a quick preview here. These methods have been around for decades, arguably even before computers, so they're not new. So what's the deal? And then we'll wrap it up with why I believe EPM embedded by analytics is a value multiplier. So let's go. I think this cartoon sets the stage for the entire talk. Drowning in data, but starving for information. You have this poor beleaguered clerk, shoulders hunched, sad, paper all around him, and the supervisor on the left in the doorway is asking him, it looks like you've got all the data. What is the holdup? I gave you the request this morning. Why don't you have an answer? So there is confusion and lack of consensus about EPM or CPM. Is it human resources? Well, if you Google just performance management, the majority of the hits will be the HR function, personnel, but employee appraisals. What we fail to do, and I say we, there's a few other authors on this topic, such as myself, David Axon at Accenture, for example, we didn't put the enterprise or the corporate adjective in front of it. It's about scorecards, dashboards, KPIs, which are key performance indicators and measures, as well as aligning the employees with the strategy, the executive team. Yes, but that's a subset. Is it about process, productivity, and quality improvement? Yes. Again, that's a subset, but that's business process management. So that's the world of lean management and Six Sigma. We're talking about enterprise performance management, which is more of an umbrella. Or is it all above and even more? Well, the good news is this. Enterprise performance management are not new methods that people have to learn, but rather they are existing methods that people are already familiar with. You may or may not have implemented some of these in your company. The problem is most organizations implement them in isolation of each other. So you may have a budgeting and rolling financial forecast in one part of the building. You've got the profitability reporting in another place. You've got the strategic planners and the KPIs in another place. You get a lot more synergy when you seamlessly integrate these methods together and furthermore embed into them analytics of all flavors, which we'll talk about. So since I believe you may be getting at these slides as a PDF, there is that definition I just described. Integration, multiple methods, each embedded with business analytics, especially predictive analytics, which we'll talk about. And the purpose, it's really about strategy execution, better performance, and making better decisions. So let's just talk about analytics. Rather than get you a definition, I could go to Wikipedia and put it in this slide, or I could grab the definition from Tom Davenport and Jeannie Harris's breakthrough book over a decade ago, Competing on Analytics. You may want to Google that, go to Amazon. I'm not going to do that. I'm going to say just work backwards with the end in mind, but there should be no argument as to what is the purpose of analytics. It's straightforward. Better decisions, better actions from those decisions. Analytics goals should be to gain insights and solve problems to make better and quicker decisions with more accurate and fact-based data and to take actions. So I sort of lied about not having a definition. That's not a bad definition. So what about the difference between business intelligence and business analytics, and where does EPM fit in? Well, business intelligence reporting consumes stored information. What business analytics does is it produces new information from the stored information. In a few slides, I'll differentiate them. What enterprise performance management methods will do, and they're really strong on their own, but they get turbocharged if you deploy analytics into them. Insights and actions. Queries simply answer questions. What business analytics does is it creates questions. Further analytics then stimulate more questions, more complex questions, and more interesting questions. And most importantly, business analytics also has the power to answer the questions. And I may get a little serious here. When I look back on my 40-year career, I believe what I've observed is the best in the past, the best executives and leaders had the best answers. Today, I do not think that is the case. I think today the best leaders and executives have the best questions. There's just way too much volatility and uncertainty and complexity for them to rely on their intuition or gut feel or so-called sixth sense or the types of decisions they made in the past that got them promoted to the top. What they need to do is create a culture for discovery and investigation and insights, and also tolerance for making mistakes as long as you learn from those mistakes. Now here's a huge laundry list of analytics in so many different areas. I won't go through it all, just a couple of retail sales, merchandise analytics like a Macy's, or a Sears, markdown assortment planning for slow-moving items in the basement, the financial services, risk and loan credit scoring, pharmaceuticals, drug development, clinical trials, and so forth. So let's go down supply chain, route optimization. You get the idea. Analytics can be applied in many, many areas. Now let's contrast business intelligence with business analytics. Business intelligence, BI, its acronym, is now increasingly being marginalized as just reporting. It starts with standard reports, then ad hoc reports, then maybe the old drill down OLAP, online analytical processing, see a line item of an invoice or a purchase order, and then the alerts. You react to that information. What business analytics does is it's proactive. You go to a step above. You start with the statistical work, regression, correlation, clustering, association, segmentation. And I know some of the older people listening to me took those courses in college and you just wanted a passing grade and be out of there. Well, sorry, it's here, big data, data scientists, but the good news is you don't have to bring your old textbook out from the basement, but you do need some skill sets in your organizations that are competent with it. Then we move on to the predictive view, the forecasting, the predictive modeling, and then when you've got an operations research degree such as I have from Cornell, that's kind of Mount Everest optimization. What is the best answer of all of the options? So let's move on to why the interest in enterprise performance management. And these are my 8 forces. And I'm going to take 2 to 3 minutes and rattle through each of the 8, and then the rest of the presentation will be drilling down into 4 of them. The first one is executive frustration with strategy failure. Executives are quite good at formulating strategy. Their big frustration is failure to execute the strategy. And there's fair empirical evidence about it. Challenger Gray and Christmas, an executive recruiting firm in Chicago, monitors the involuntary turnover, firing, terminations of CEOs, and it gets higher every year. What's happening is board of directors post-Enron take their job of governance much more seriously. If a CEO isn't pulling off the strategy, they're out of there. Carly Fiorini at HP being a good example. Next, increased accountability. Today, there is no place to hide. Employees will be measured and monitored. It doesn't necessarily mean their jobs are at risk, but it could adversely affect their salary increases or job promotions. 3, more rapid decision making. Unlike 4 or 5 years ago when you could test and learn and have conference room meetings with your supervisors, today people will be on the phone, go or no go, yes or no. They need to make that decision on the fly. They almost wish that the C-suite executives were sitting next to them and say, what decision should we make based on your strategy? 4, mistrust of the management accounting system for transparency and accuracy. Most managers do not trust the accounting system for that accuracy. We'll talk about activity-based costing when we get to that section. 5, poor customer value management. I believe that in almost every industry today, customers now view suppliers as commodities. Banks all have the same kind of deposits, insurance companies, different types of programs, so on and so forth. Therefore, for a customer to actually, for a supplier to be competitive, they need to provide differentiated services to different types of customers. Not all are doing it well. 6, contentious budgeting, poor resource capacity planning. This may surprise some of you, but I believe that the annual budgeting process is so broken and is such a disaster that the best thing to do is abandon it altogether. Stop budgeting. I probably caught some of your attention there. But that begs the question, what was the purpose of a budget in the first place, and can we replace it with something else? And we will talk about what I will call performance-based budgeting. 7, dysfunctional supply chain management. The issue there is most customers view their suppliers as the enemy. They pound on them almost like if they drive them out of business, they say, well, we can just get another supplier. That's got to change. That's got to be a love friendship because supply chains are competing against other supply chains for share of wallet. They need to identify mutually beneficial opportunities, projects, and cost savings in the interface between trading partners. 8, unfulfilled return on investment promises from large IT systems like CRM systems or ERP systems, lack of integration. And I pose this, that if you ask a CIO 2-3 years later, after they have actually implemented an ERP tool, even like SAP, ask them, how well do you think the ROI met or exceeded what the salesperson from the software vendor sold you on 3 years ago? I think many would be hard-pressed to say yes. That does not mean you shouldn't do it. You have to basically implement ERP systems. The problem is it produces so much data that the real ROI is latent. It's stuck inside all that data, and what the EPM methods does is it releases the data like seeds from the ground into information. So that's the forces. Now the rest of my presentation, I'm going to drill down into these four. And let's start with the first one, failure by executives to execute their well-formulated strategy. This is where the tools, you've probably heard of the balanced scorecard and a strategy map. But above that is something arguably more important. It's the vision and mission statement, and that must come from the executives. In my mind, that's their job. They need to answer the question, where do we want to go? But what the enterprise performance management methods answer is a different question. How will we get there? What are the projects? What are the initiatives we need or core processes to improve? Now, many organizations allegedly claim they have a balanced scorecard. I mean, Kaplan and Norton implemented or wrote the first book 10 years ago. And by the way, back on my background, I was very fortunate in my career. I think careers have a lot to do with luck and circumstances than being smart and competent. I got recruited to KPMG in 1988 when they struck a relationship with Harvard Business School professor Robert Kaplan. It was before the balanced scorecard work. It's when he did the pioneering work in activity-based costing. And I authored a book, and that's what led to those other books that you may have seen in my bio. We can return to that later. I'm not pushing my books. It just sort of caused my career to be more of an educator than, if you will, moving to the top. But the strategy map is arguably orders of magnitude more important than the balanced scorecard. The balanced scorecard is just a feedback mechanism. The real intelligence, the GPS, is in the strategy map. And this is just a 60-minute webinar, so not a long workshop. I'm going to quickly describe the logic behind a strategy map. What Kaplan and Norton realized is executives were overreacting to financial results reported at the end of the period. They said, you need to shift your attention to non-financial metrics and data that's collected during the period. And they created this 4-perspective map, and it starts from the bottom. It's kind of bottom to top, learning and growth and innovation. And each of these rectangles, which I'll describe in just basically represents such things like what's the strategic objective, what would be the projects or initiatives that would accomplish it or a core process to improve, what would be 2 or 3 KPIs per each one, per each objective, what would be a target for that, and then basically variance analysis. So if you start at the bottom, if the employees are accomplishing the learning and growth and innovation objectives, they'll contribute to the internal process improvement objectives. And if they're accomplishing those objectives, they'll contribute upward to the customer retention, satisfaction, and loyalty objectives. And if they're accomplishing those, then they'll contribute to the financial results. So it's like a force field in physics, where you're aligning the behavior of the employees and managers with their priorities with the strategy of the executive team. Each of the arrows you see there would be KPIs. You get what you measure. If you can't measure it, you can't manage it. Now here is a simplistic, fictitious strategy map just so you can see examples of strategic objectives with names. But to summarize, a learning environment will stimulate process excellence. Process excellence will lead to customer intimacy, loyalty, retention, satisfaction, and that will then create the financial value for the shareholders. So to simplify, I believe, imagine if every employee in your organization every day could answer this one question. How am I doing on what is important? How am I doing on what is important? Well, the first half of the question is easily answered. They come into the office, turn on their computer, they look at their dials, and are they favorable or unfavorable to the target? The real challenge is the second half of the question on what is important. What are the measures that we should be measuring? Strategy maps and scorecards provide this answer. Overriding purpose of a strategy map and scorecard system is to make mission and strategy everyone's job. It's almost like making owners out of the employees. Now, some of you listening have already put in a balanced scorecard and you're familiar with what I'm talking about. And this is what I consider to be a lesson learned that you may or may not agree with me. KPIs or just operational PIs. And what led me to observing this is in my past when I would meet with clients or companies that had it in, I'd say, well, how many KPIs do you have in your strategy map? And they'd probably say, oh, like 300. I said, that's great. It's outstanding. How can they all be a K? They can't all be a key performance indicator. So I want to quickly distinguish the difference between KPIs and operational PIs. They're all important, but they serve different purposes. KPIs are strategic, and they belong to be displayed in a balanced scorecard because there's cause and effect relationships. In contrast, PIs are operational, and they should be displayed in dashboards because those don't have connectivity to each other. Next difference, KPIs must have targets because targets is all about the motivational theory. In contrast, PIs can have targets, but they don't have to. They could be trends or upper bound, lower bound control limits. Next differentiator, frequency of reporting. Quarterly, monthly, maybe weekly. But once we get to daily, hourly, or near real time, we are in the land of operational PIs. They're not strategic. Next, KPIs should be derived from a strategy diagram. And I use diagram in place of map because not everybody is wed to the Kaplan and Norton for perspectives. Some of the large chemical companies may have safety and health, for example. And you should custom and tailor them to the strategy map. You don't want to go, or the strategic objectives, to some website and say, well, here's oil and gas industry or banking industry. This is what they're using. No, you want to tailor it like a men's or women's suit of clothes. Next, both process-based and project-based KPIs. Most organizations only exclusively have process-based. Why you have to have project-based, and examples would be percentage of completion or milestones, is strategy is all about change. It's not about doing the same processes over and over again, but just a little bit better. And then finally, the budget is disconnected from the strategy, and we will talk about that when we get to that section. So let's move on to the next force. Mistrust of the management accounting system and its flawed cost allocations and misleading cost reporting of outputs, products, standard service lines, channels, customers, and outcomes. And the typo that someone pointed out to me said that's not cost allocations, it's misallocations. Most managers are upset and disturbed by the allocations that come from the accountants. And this is really what has led to activity-based costing. And this is the simplest way that I try to explain it, especially to non-accounting people. Imagine you go to a restaurant with 3 other friends. You order a little salad and the other 3 order the most expensive item on the menu and a glass of wine. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, that's how also in an accounting system, general ledger, the products and standard service lines also feel when the accountants take this large blob of indirect and shared expense, typically called overhead, and allocate it like spreading butter across bread using factors like direct labor hours, machine hours, number of units produced, sales amount, dollars, euros, whatever the currency, full-time equivalents, square feet, head count. None of those factors reflect the unique consumption that those various products or service lines consumed of the end-to-end business processes and the work activities that belong to them. So if you were to properly trace those various activities to the outputs, you'll discover that some of the products or service lines are overcosted and the others must be undercosted because it's a zero-sum error game. That means that the accountants are providing flawed and misleading information to their line managers. Yes, it reconciles in total, so it passes the audit with EY, Deloitte, Pricewaterhouse, whoever, but it's wrong in the parts. So the simple definition of ABC, it's as if the waiter or waitress brings 4 individual checks. You pay for what you consume. The problem actually begins with this traditional responsibility cost center statement. Every manager on the planet Earth recognizes this report. But when they receive it, they ask themselves, how much insight and understanding do I get about the cost that I can influence and control? And the answer is not much. All I know is what I spent. And I like to say when managers get this kind of report, they're either happy or sad, but they're rarely any smarter. What activity-based costing does is it makes them smarter. it translates the same data, and there's the problem. The problem with the cost center is the data is structurally deficient. It's not in a format that allows to provide the further answers. So it translates that 919,000 into the language of work in the middle, key scan claims, analyze claims. Notice I'm using the back office of an insurance company. It's a factory too. And then it reassigns those activity costs into the products or channels or customers, just like the waiter or waitress in the restaurant, based on some sort of driver quantities that reflect the consumption. Now, I've rotated that slide 90 degrees to the left. It's not as simple as taking ledger expenses, put them into activity cost pools, and assign them to cost objects. Most organizations are the right side. You've got support departments that support other support departments that eventually support the frontline departments that make products or interact with customers. So it has to be a multi-stage cost assignment network. Get prepared. The next slide is going to look pretty complicated, but I'll walk you through it. And incidentally, if you want to know more about this topic, if you go to the website of the Institute of Management Accountants, www.imanet.org, and just Google my name, you'll see a 30-page statement of management accounting. It's actually an excerpt chapter from one of my books. When I retired 4 years ago, the IMA CEO, and the IMA has 94,000 members in 140 countries, he phoned me up and said, Gary, not going to let you sit in a rocking chair down there in Raleigh, North Carolina. They created this part-time role as executive in residence, and so I write articles for their magazine, 2 a year, 8 of them so far. What's the diagram? Let's get back to it. It's got the 3 universal components of any organization's expense and cost structure. You've got the expenses at the top that for the general ledger. They are translated into or to the work activities in the middle, and they will eventually pile up in the bottom 2 boxes, the customer box and business sustaining. Now, you need to adjust your thinking. This is not a flow chart with swim lanes. This is a reassignment cost system. So if a company had $2 million of spending in January, it will be the exact $2 million of work activities, and they will pile up, eventually accumulating in the bottom there, the customers and the business sustaining. In that bottom module, I like to refer to it as the predator food chain, like in biology. Large mammals eat small mammals eat plants. The cost will be properly assigned to those products, tracing them using cause and effect relationships. Then between the products and the customers, we will go to the sales register and get the volume and mix of what did the customer buy. Business sustaining is a special final cost object. There will be expenses that have got nothing to do with making product or delivering services, things like the legal department or when the accounting department is closing the books. So we create a business or a final cost object like senior management. They're like an internal customer that causes the need for reporting and so forth, or regulatory agencies, Department of Transportation, IRS, and so forth. And so we want to park that money aside because we don't want to overcost the products and services. Typically, that may be 10 to 15% of an organization's expense structure. Yes, you still need to recover it to be profitable, but we don't want to trace it to products or customers. Look at all those arrows and reverse the arrows in the opposite direction. And think of those arrows as thin straws or wide pipes where the diameter reflects the amount of money going through. If we reverse from the bottom to the top, that's what's happening in any organization every minute, hour, day, week, month, year. The customers and the products and service lines are placing demands on the workload in the middle. The workload's drawing on the expenses. The costs measure the effect in the other direction. It's a principle. Rules are many, but in costing, principles are few, like speed of light or gravity. You can't violate it. Well, the accountants will violate it when they peanut butter spread those indirect expenses. But the message here is costing is modeling. It is not T accounts and journal entries. Direct cost, not broken. You may have data integrity issues here, but that's a different story. But the majority of expenses in organizations today tend to be indirect with all of the variety and diversity, color, sizes, ranges. It creates the need for more and more indirect to manage all that complexity. Now, this page is much more important than the previous stuff. What do you see when you use ABC? And this is the famous humpback whale curve, or the profit cliff. The vertical axis is the net revenues minus the properly calculated and traced ABC. The horizontal axis is the cumulative buildup of profit, but it is rank ordered from the most profitable product to the second most profitable product and so forth. The last data point will always reconcile exactly with the P&L. So in this particular real case, and incidentally, the reason it's a crummy looking diagram is this was my first ABC project in 1988. Like the baby picture you put in your wallet. I was so proud that it happened. They had $30 million in revenues, 28 in expenses to net out at 2, and the last data point is 2. But when the management team saw this graph, they were in organizational shock, which always happens, because it said, look, you made roughly $8 million of unrealized profit on 3/4 of your most profitable products, and you lost $6 million on the remainder. And they thought that that graph was this little anthill with the hook on the end. That was their belief system. And what was happening was all of that peanut butter spreading of allocations was crushing and suppressing the accuracy. But the multi-stage cost assignment network was detecting the diversity and variation and basically lifting it up and putting it into the right cost. So the top line is truth. The bottom line is basically flawed and misleading, although it does reconcile. Now, some of you may be asking, well, what do you do with the unprofitable products to the right? Do you drop them? No. That could be a big mistake because companies will have loss leaders that are associated with winners. So you couple and bundle them together. Or cost accounting does a terrible job with life cycle costing. It's always period costing, January, February, March. So if you've got a new product that's just been released and it's got low volume sales and there's an extra cost from the shakeout period, it's going to be unprofitable. But when you refresh the model, those dots are going to move to the left. But the point is this, at least the top line is fact-based data. At least it's fact-based data. And always remember this, if you take anything away from these 60 minutes, in the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one. But usually the biggest opinion wins, which is the opinion of the boss or the boss of the boss. So to the degree they're making decisions on gut feel or intuition or flawed and misleading information like the blue line or office politics, the organization's at risk. Now there's much more here that meets the eye in each of those data points. This is a single product. Each product is reaching up into those work activities and asking, how much of each of you did I uniquely consume? And it piles them up like pancakes, where the thickness of the pancake reflects the quantity of the driver, number of material moved, number of blood tests for a hospital, times what's called the unit level consumption rate, $450 for blood test. And this gives transparency and visibility to the costs, which are hidden when you use a standard costing single overhead cost pool. And so if the operational people can reduce the frequency, quantity, or intensity of those arrows, the stack will go down. So there's some opportunity for cost management, but the real value of ABC tends to be strategic, and that will move into become apparent when we look at the next force. The shift from being product-centric to customer-centric. The value of a company is a function of the value from its customers. The only value a company will ever create is the value that comes from its customers, the current ones and the new ones acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like existing profitable customers. But we've got a couple of problems. Most accountants don't measure anything below the product gross profit margin line, so they don't really know what makes a profitable or less profitable customer. And the other problem is sales and marketing gets commissions on sales volume. And it's no longer about just producing growing sales, it's about growing profitable sales. But those can be rectified. The issue is this. Product and standard service lines are not the only thing which accountants should compute costs for. What about costs that have nothing to do with making products and delivering standard service lines? I'm talking about marketing, selling, distribution, customer service. The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture, and I'm going to make a case that the bottom half is more important than the top half. And what do I mean by bottom half and top half? This is the top half. If the entire rectangle is the expenses for an organization for a month, January, February, the product is only the shaded part. Direct material, direct labor, equipment, and the indirect, and ideally the indirect would be traced based on ABC. And also don't get the impression that this is all about manufacturing. We all recognize the majority of companies, organizations today are service organizations. So this universally applies. But when we move to the white space, now we move for the products through the distribution, sales, marketing, and so forth, and customer, that white space is more important. And why is this? I'm going to give you 4 reasons. First, customer retention versus acquisition costs. It is much more expensive to acquire a new customer than to retain an existing one. That's a no-brainer. Existing customers you already have, so they're a sunk cost. And when you get into decisions theory, you don't pay attention to sunk cost. You only look at incremental and marginal expenses. Next, sources of competitive advantage. Commoditization leading to service differentiation. I already previously kind of mentioned this. Customers view suppliers as commodities. Therefore, for a supplier to be competitive, they need to provide differentiated services to different micro-segments of customers. Next, from mass selling to one-to-one customer relationships. It's no longer about have R&D, research and development, create a new product and have the sales force go push it out. Work backwards knowing the unique preferences and traits and characteristics of individual customers or consumers and tailor the offers, the deals, the price discounts to them. And then finally, the Internet. The Internet's irreversible shift of power from sellers to buyers. This is a one-time event happening in our lifetime, and I don't mean just you and your spouse or family doing shopping on the Internet. Today, a purchasing agent at a company with a click of a mouse can see 20 to 30 suppliers and all of the information about them. So when we look at all of these four, and probably much more if this was a workshop with flip charts, you realize this bottom half is far more critical than the top half. And now there's a different type of problem. High maintenance customers and low maintenance customers. Examples of high maintenance customers, always changing schedule. Never buying standard, always special, always calling help desk, always returning goods. Low maintenance customers, you love them. Only buy standard, never shift schedule, never call help desk, never return goods. If those two types of customers bought the same volume and the same VIX at the same price, they're not equally profitable because the high maintenance ones are basically eroding your profits by all the extra work you've got to do for them. I used to refer to them as angel customers and demon customers, and then this book came out. But the book is by marketing people from Columbia University. But what caught my attention was not the main title, but the subtitle. Discover which type of customer is which and turbocharge your stock price. And this should be a revelation to all of us. We need to connect customers to shareholder or owner wealth creation. But the problem is the accountants are stopping halfway. That bridge is only halfway built. They stop at the product gross profit margin line. We need to calculate customer P&L by each customer. And this is an example. And when you bring in all of those various activity drivers layered in a proper sequence, you will get a P&L by customer, and the margins will be like an onion skin, layer by layer by layer. And in this fictitious example, you can see at the far right that there was a 30% composite profit margin on the products and service lines. But between the 30 and the 8 below, 22 more points of profit margin are eroded, got nothing to do with making product or service lines. It's all in the distribution channel and marketing. And if you calculate those two swaths for each customer, you can put it onto two types of graphs. The first graph is this one. The vertical axis, all the squares are customers. The vertical axis is how profitable plus or minus. The horizontal axis is the sales volume. And you can see that box that's farthest to the right is the largest sales customer. But notice above it are some customers more profitable with less sales. But look at the bottom, pretty sizable customer sales volume and unprofitable. What this means is sales volume is no longer a proxy for profitability. And if we take the same data points, and now that I've got them as circles, and put them as intersections into this grid, the vertical axis is the profit mix profit that a customer is buying. High profit margin at the top, low at the bottom. The horizontal axis is that cost to serve, the below the line, the angels to the left, the devils to the right. And now things become obvious. The worst and most unprofitable customers are in the bottom right. The most profitable ones in the upper left. And now the name of the game is move the dots from the bottom right to the upper left. And that would be another, quite frankly, webinar for ASUG for marketing people, things like cross-selling or upselling. If they buy a set of golf clubs, can I sell them a golf shirt? If they buy the golf shirt, can I sell them, another shirt at a discount? Or unbundling, start charging individual fees for individual services. The banks have been doing that a long time now. The airlines do it with baggage. You get the idea. Some of you may be saying, way, I think Gary is really selling me on this idea of ABC, but it's really complicated. We'd have to triple size the accounting department. Every employee would have to fill out a timesheet. Employees hate timesheets. We'd have 3,000 activities, and IT would have to basically extract them all. Those are all misconceptions. Real quickly, the best way to implement ABC, and this is a service that I do provide, is only 2 days of my time, so not a big deal. Rapid prototyping with iterative remodeling. You build that first model zero in a room with 5 or 6 cross-functional people. You don't really care about whether the data is usable. You want to bring in the executive team and peer managers. Noon of the second day, have the 5 people show them that higher level model, and the light bulbs go on. The aha is like, wow, so that's how it works. Oh, you can use a lot of estimates because everything normalizes to 100%, so on and so forth. A couple of more iterations, you've got a permanent, repeatable production system. This is the way to implement. And the why it works is because of this graph. The vertical axis is the accuracy of typically what you want to know, 0 to 100%, let's say product cost. The horizontal axis is the administrative effort to collect the data, validate the data, calculate it, and report it. You will see you always get an asymptotic curve. It goes up accurately fairly quickly, and then you get diminishing returns on extra accuracy from the extra level of effort of work. The question is, how do I get that slope to go high quickly? What determines accuracy? And this is counterintuitive to most accountants. It's that multi-stage cost assignment network. The piping in that diagram with the cause and effect relationships is really where most of the accuracy comes, and then come the activity drivers. So, this is not mandatory to do ABC. This is not external reporting for financial reporting for the SEC and so forth, regulatory compliance. This is internal. So it's okay to be 95% accuracy. We use the phrase, it's better to be approximately correct than precisely inaccurate. I'm not sure why this slide is in there, but it seems like it's been placed, but I'm just going to continue on, okay? Next, so to summarize, what's really happening is the CFO has to shift their emphasis from not just pounding on operations to get their costs down and serving board member reports. They need to basically help sales and marketing. The spending budget for sales is critical. It should be treated as a especially scarce resource aimed at generating the highest long-term profits for shareholder wealth and owners. This means answering questions like, what type of customer is attractive to newly acquire, retain, grow, or win back, and which types are not? And then there's the more sophisticated question, how much should we optimally spend attracting, retaining, growing, or recovering each customer in microsegment? And it is an optimization problem because you can overspend on loyal customers and arguably destroy shareholder wealth. You spent too much on them. But you could, in contrast, underspend on marginally loyal customers and risk their defection to a competitor. So you really got to think about each microsegment. What is the right amount? Okay, got to move even faster here because we only got, 20 minutes to go. Budgeting. You heard me tell you this, that the budgeting process is broken. The budget is typically a fiscal exercise by the accountants that has 2 issues. It's disconnected from the executive team strategy, and often it is not based on future driver volumes. How many organizations do the budget? Well, first of all, let's talk about problems with the budget. It takes a couple of months, maybe 3-4 months to prepare it in the first place. It's obsolete in a couple of months after it's produced. Caves into the loudest voice, strongest muscle of the veteran managers know how to sandbag the budget and pad it, if you will. There's always these 2 or 3 executive tweaks after you produce it the first time. They don't like the numbers and go back and redo the numbers. What really bothers me is when a manager is 3-4 months on the glide path from the end of the year and they haven't spent all of the budget that's allotted to them. What do they start doing? They start spending needlessly, foolishly, because it's use it or lose it behavior. They know that next year's budget is going to be pegged to the projection. I call it spreadsheet budgeting. So this is the projection of their budget, a cost center for the end of the year, wages, salaries. Give them a 5% inflation increase, 1.05, and copy down. Some of you should be laughing a little bit because this is ridiculous. What if this department's going to have a 30% increase in demand next year? They're going to be understaffed. What if they're going to have a reduction like bank tellers getting replaced by ATMs? They're going to be overstaffed. So the question is, what do we replace the budget with? How do we do it? And here's how. Think of the amount of spending that you're going to have at the bottom to the right is the result of two river streams coming at you. The recurring repeatable work, which is demand-driven, and the non-recurring non-repeatable work, which is project-driven. So let's dive into what's in these two river streams. For the repeatable work, with the activity-based costing, it began with basically always the historical view. You wanted to know what things cost. But in the late 1990s, a few of the really innovative users, and I was involved with ABC, said, can we do the budget next year? And what the programmers realized of the software is, look, if you could forecast the volume and mix of what's going on, I will backward calculate it to solve for the level of resources. So another way of thinking about this, I'm going to skip through this one, is in the historical view, the spending is known, and what we calculate is all of the activities to pile up into the cost objects, but we pick up unit level consumption rates. So for the predictive view, we forecast the volume and mix, multiply it through the unit level consumption rates to solve for the level of headcount and spend. My industrial engineering curriculum at Cornell in 1971, I think it was second semester freshman year. Volume and mix times unit level consumption rate equals capacity required. Now let's talk about the project related. Enterprise risk management is beginning to be combined with enterprise performance management. And the risk management community uses this grid. Each of those circles you see is a potential risk for the upcoming year or future. Vertical axis is the severity of impact of the risk occurring. Horizontal axis is the probability that it occurs. So if you're in the upper left where they're shaded blue, it means, hey, there's a higher probability these are going to happen and they're going to be painful, then budget for them. So let's summarize. Let's look at these two river streams. For the repeatable recurring work, we calculate the bottle backwards to solve for the level of headcount and spend. For the non-recurring work, we're really going to have three types of projects. We're going to have strategy projects, which I didn't go into, but I referred to it loosely about the strategy map. For each of those objectives, you identify the projects and initiatives, and you fund them. If you don't fund them, then you're not going to basically get the strategic objectives, which is going to adversely affect the CEO's career. We were talking already about the risk grid, and the third one is capital budgeting. And almost all of us are familiar with capital budgeting for asset purchases in the future. So if we're doing all of these correctly, it's going to be a much better number than consolidating all these Excel spreadsheets up, down, up, down, up, down, up, down. And I'm going to decompose the diagram. I won't go into it in great detail, but if you look at the bottom right, there it says the derived budget. Notice its inputs. From the top is the upper river stream. The operational budget. From the left are the three projects: strategy projects, risk mitigation projects, and capital projects. That is going to be a much better number to the degree that the forecast is reasonably accurate. The forecast is arguably the only independent variable. If you've got systems like SAP, you've calibrated all of the other relationships. So they're all dependent variables. So you just can refresh the model at periodic intervals, and we've now moved to rolling financial forecasts. And let's talk about rolling financial forecasts. Every forecast is going to be less accurate one day, 1 week, and 1 month as time passes. That's that first curved line to the left. But if we refresh the forecast at frequent intervals, let's say quarterly or perhaps monthly, we can basically then create a new rolling financial forecast that's going to be more current and reflect what people are viewing. And that can actually, for any of the accountants listening to me, can produce pro forma income statements and bank statements, and then actually slide into cash flow statements, so that the treasury function can know in the future, am I going to have to borrow money or am I going to have surplus cash to invest? It is trickier, though, when you go to the predictive view. The historical view is pretty straightforward. I refer to it as the cost autopsy. The spending's known. Where did it go? We use the driver assignments. But when we go to the predictive view, we have to classify the behavior of the resources relative to changes in demand as sunk, fixed, step-fixed, and variable. We start becoming microeconomics, because in the short term, all costs are fixed. So it's very difficult to adjust capacity in a day or a week. But as the planning horizon goes out weeks, months, years, you can start replacing full-time employees with temps. You can lease assets that you might have purchased. So we really have to get into marginal and incremental expense analysis. That's why I said you've got to think like an engineer. Real quickly, this is a diagram a taxonomy diagram that I created for IFAC, International Federation of Accountants. They're in the New York City. They're the United Nations of Accounting Institutes, 180 members, AICPA, IMA, and 178 more. I'm going to flow it out completely. Here's what it's basically saying. First, accounting is all data will basically become accounting data, but we calculate costs from the accounting data that comes in from procurement systems or purchasing system. When we go to external reporting, we follow GAAP, G-A-A-P. See that arrow, General Accepted Accounting Principles. That's for inventory valuation, cost of goods sold. Management accounting, though, we make different assumptions. We're going to we don't care about rules for the SEC. And so that's where we will do the modeling I talked about here. But notice to the far right is the future view, decision support and cost planning. And that's really what it's all about. That's that predictive view. What if scenario analysis, sensitivity reporting. And some of the accountants get upset when they look at the bottom where I've got low value add to the left, modest value add in the middle, high value add to the right. It basically means, look, the real value from accountants is much more involved with, if you will, managerial accounting than external reporting. So let's start wrapping it up, and maybe there'll be some time for some questions. This is my diagram of what does enterprise performance management look like as a big picture. Think of this as a circulatory system, like your blood, your heart is in the middle. I'll go into it in a few seconds. But what we want to do is we want to connect customer loyalty, satisfaction, retention to shareholders. That's that. Remember that book, Angel Customers and Demon Customers. Identify which customers or types are which and turbocharge your stock price for your shareholders. Where's management accounting and analytics in the diagram? I don't have it there because the output of those are the inputs in so many different places. They are pervasive. Okay, how does the diagram work? We start with the customer needs are used by the executive team to formulate strategy. And I know some of you are familiar with Michael Porter and competitive advantage and 5 forces and all that. Let's just keep it simple. The executives will formulate strategy based on customer needs. They will communicate it to employees in a way that they can understand it, based on the strategy map, the enterprise, the risk grid, and the balance scorecard. And then they will basically provide the feedback to employees about how they're doing. Remember, how am I doing on what's important? Those 3 arrows are strategy execution. Then we move to the profitability, that customer profitability, the targeting, which types of customers should we retain, should we grow, should we win back, should we acquire, which types not, how much will we optimally spend? Then comes what probably many of you listening to me are familiar with, Six Sigma, lean management, and it's okay. This is the process view. This is, better, faster, cheaper, but it's not the total picture, accept the order, complete the order, accept the hospital patient, complete the patient. And here's the point. We want to connect all of these arrows to the shareholders. And I'm hoping it may show up. We may have a little bit of a grid or a PowerPoint problem as we move to the platform here, but you can see these bubbles rolling through. What it's really saying is those are all like veins in your body, if you will. And so arteriosclerosis of the performance management, if a vein is narrow, we've got to widen it. So when people ask me, what's the IT roadmap for the full vision of performance management, I say there is no roadmap. What there is a starting point, customers, and an ending point, shareholders. Where you put your time and attention really depends on the executive team to know where are we weakest. If we don't know where we make or lose money, do the ABC. We don't know which customers to retain and grow, same thing. If managers and employees don't understand the strategy, communicate them with KPIs. But my point is this, don't wait 3-4 years to do each of these. Do it in the next 18 months or sooner using rapid prototyping, proof of concept, and the like. But to the degree that there's excess idle capacity, inefficient processes, or waste, notice the money doesn't go to the shareholders, it leaks into the sewer. So this diagram is really like an optimization diagram. So to wrap up, what's really happening here, I think, is there is a shift between the ROI from tangible assets to intangible assets. Meaning the ROI for a company comes less from investment in, computers and trucks and machines to information. And when we basically look at the return on information from left to right, we're basically going from data to information to knowledge to insights to decisions. And it increases exponentially. The problem is most organizations are stuck in the first 2 red bubbles. All they've got is raw data and standard reports. All they can answer is, what happened. In some cases, CIO gives some managers some drill-down software OLAP, so people can go to the line item of invoice or purchase order, but they're still limited to answering what happened. The 3 blue bubbles is where enterprise performance management starts. It begins with descriptive modeling. Costing is modeling. A strategy map is arguably a model on a single page of the strategy. Now you not only know what happened, you know why did it happen, because you've got cause and effect principles at play. Then we move to the predictive view. The forecast is the future's coming at you. Now we can do all those what-if scenarios and the like, and we can answer not only what happened, why did it happen, what can happen, and then again, if you got a OR degree like me, Mount Everest, optimization, predict the prescriptive analytics, which is the highest end of all the options we could choose, what is the best choice, and keep your eye on SAP. You're eventually going to basically start getting into linear programming, that kind of stuff in the tools. So, click one more. Here's my big frustration. Why is it taking so long for organizations to adopt these? Whoop. And let me just describe them. Oh, wait a second. Oh, somehow the slide got in there. Here are the 4 reasons, then we'll have some quick questions, and then you can also send emails to me. First barrier is technical. Dirty data, low-quality data, disparate data sources. IT can solve that with ETL, extraction, transform, and load. Second barrier, perception. You know, people think it's too complex, it will take months and all that stuff. I think I described with rapid prototyping, you can have a permanent repeatable production system or a strategy map. I also do a workshop building a strategy map in a day, in weeks, not months and years. The technology is no longer the impediment. This is the main barrier that is slowing the adoption rate. It's all behavioral, organizational behavior, resistance to change. People like the status quo, fear of knowing the truth or other departments knowing the truth, fear of being measured, fear of being held accountable, weak leadership. All of that stuff is people stuff. What it means is we're going to have to really get better at change management, and very few of us really have those types of psychology or sociology degrees. So if you do get these slides, there's a couple of links there that have got some articles I've written. Some are shorter, some are longer. Google me. I like to basically end by saying, look at these titanium gears spinning faster, quicker, revolutions per minute, better, faster, cheaper, but also safer, risk management, and smarter, bringing in the KPIs from the strategy map. Your success depends on how well and how fast the right information and intelligence gets to the right people. I'm not pushing my books. In fact, if you don't make a lot of money, believe me, as an author, the publisher keeps most of it, but if you go to Amazon, typically Chapter 1, definitely Predictive Analytics, is a free download, and it'll give you a quick overview. So I'm going to send it back to Susan, and I'm sorry that I knew it would be the MBA curriculum in an hour, but I will welcome any questions now, and definitely email me at gcokens@garycokens.com. So Susan, I'm back to you.
Hi, Gary. Thanks so much. Great webcast. As you said, right now we do have a few minutes for any questions that you have. So anyone in the audience, please feel free to go ahead and submit those questions using the purple button at the bottom of your screen. And while we wait for those to come in, and you can also reach out, like Gary said, reach out to him directly with any questions.
Well, Susan, let me, if I could, since it may be that there may not be, let me just say that the common question I typically get is, what is the major lesson learned in implementing this? And I want to just come back to sort of how I ended. It's not about the math. It's about people. And the major lesson I've learned is you really have got to either involve people, get their buy-in, overcome their resistance, and the best way, and I know this is really kind of strange, is you almost have to create dissatisfaction in them. You've got to ask them questions like, do we know where we make or lose money? Are we measuring the right things? And that creates, especially with the executives, once they start getting queasy, the fear, uncertainty, and doubt, they will start looking for the lifeline. Well, how would I fix that? And then you've got the methods to say, well, you can use this technique or that technique. And so that's the major lesson learned that I've discovered. So I believe it's just a professional courtesy to end on time. They scheduled for an hour, so I'm going to ask you to do the wrap-up, and people can communicate questions to me to my email address. So I'm back to you, Susan, and thanks so much for inviting me. Well, actually, to Paul Ovigel and ERPfixers. Everybody, please go check out that website. I mean, it's like the Uber or Airbnb of the future. You can actually get help from individuals with your SAP technical problems and other types of problems. So back to you, Susan.
Thanks, Gary. Thanks again for a great webcast. On behalf of ASOG, I'd like to thank again our presenter, ERPfixers, as well as all of you who took the time out today to attend this webcast. Before I go, I'd like to leave our audience members with some quick information for ASOG. For anyone who's unfamiliar, ASOG helps connect SAP customers to people and information that provide insight, influence, and inspiration that they need to maximize their investment in SAP and drive innovation within your organization. We offer 38 local chapters, 90 special interest groups, including access to digital content like this webinar. For any more information on ASOG, please send us an email at info@asog.com. The recording and slides from today's program will be posted on the ASOG website, and all registrants will receive an email with a link to those materials. Please give us about 48 hours for those materials to be available online. And if you wouldn't mind, please take a moment to complete this survey by clicking on the green survey button at the bottom of your screen. With that, I'd like to close today's webcast, and have a great rest of your day, everyone.